In today's interconnected global economy, individuals and businesses are increasingly exploring offshore tax strategies to optimize their financial positions. By leveraging favorable tax jurisdictions, one can potentially reduce tax liabilities, protect assets, and enhance financial flexibility. However, it's essential to approach offshore tax planning with a thorough understanding of legal frameworks and compliance requirements to ensure all actions are legitimate and effective. Offshore tax planning involves structuring your financial affairs to take advantage of the tax benefits offered by foreign jurisdictions. This can include establishing offshore companies, opening bank accounts, or investing through offshore vehicles in countries with favorable tax regimes. The primary objectives are to minimize tax obligations, protect assets from potential creditors, and diversify investments across different legal and economic environments. 1. Reduced tax liability. By situating assets or business operations in jurisdictions with lower tax rates, individuals and companies can significantly decrease their overall tax burdens. For instance, some countries offer zero or minimal corporate tax rates, which can be advantageous for businesses seeking tax efficiency. 2. Asset protection. Offshore jurisdictions often provide robust legal frameworks that safeguard assets from lawsuits, creditors, or political instability. Establishing trusts or foundations in these regions can offer an additional layer of security for personal or corporate wealth. 3. Investment diversification. Holding assets in multiple countries allows for diversification, reducing risk and potentially enhancing returns. Different markets offer varied opportunities, and offshore structures can facilitate access to these investments. 4th, estate planning. Offshore entities can be instrumental in estate planning, enabling the smooth transfer of wealth to future generations with minimal tax implications. Certain jurisdictions offer favorable conditions for setting up trusts that can manage and distribute assets according to specific wishes. Incorporating offshore companies. Establishing a company in a tax-friendly jurisdiction can lead to significant tax savings. These companies may benefit from lower corporate tax rates, reduced reporting requirements, and greater confidentiality. However, it's crucial to ensure that the offshore company has a legitimate business purpose and complies with both local and international laws. 2. Utilizing tax treaties. Many countries have double taxation treaties that prevent the same income from being taxed in two different jurisdictions. By strategically choosing countries with favorable treaties, one can minimize tax liabilities. It's important to understand the specifics of each treaty to effectively utilize this strategy. 3. Establishing offshore trusts or foundations. These legal structures can hold assets on behalf of beneficiaries, providing tax benefits and asset protection. They are particularly useful for estate planning and ensuring wealth preservation across generations. The terms of the trust or foundation should be carefully crafted to align with financial goals and comply with relevant laws. 4. Opening offshore bank accounts. Offshore bank accounts can offer access to international investment opportunities, potentially higher interest rates, and currency diversification. They also provide a level of financial privacy. However, it's essential to report these accounts as required by law to avoid legal complications. While offshore tax strategies can offer significant benefits, it's imperative to operate within the legal frameworks of all relevant jurisdictions. Engaging in tax evasion or failing to disclose offshore assets can lead to severe penalties, including fines and legal action. Therefore, transparency and compliance with international tax laws, such as the Foreign Account Tax Compliance Act, FATCA in the United States or the Common Reporting Standard, CRS, globally, are crucial. Selecting an appropriate jurisdiction is a critical aspect of offshore tax planning. Factors to consider include the country's tax rates, legal system, political stability, and the availability of tax treaties. Some of the most popular offshore jurisdictions include Cayman Islands, known for zero corporate tax rates and strong confidentiality laws. British Virgin Islands, BVI, offers favorable tax laws and ease of company incorporation. Switzerland provides low tax rates for certain types of income and a stable economic environment. Singapore features competitive tax rates and a robust legal framework. Each jurisdiction has its own set of regulations and benefits, so it's essential to conduct thorough research or consult with a tax professional to determine the best fit for your specific needs. Offshore tax strategies can be a powerful tool for legally reducing tax liabilities, protecting assets, and achieving financial goals. However, they require careful planning, a thorough understanding of legal obligations, and ongoing compliance with international tax laws. Consulting with experienced tax professionals is advisable to navigate the complexities and ensure that your offshore tax planning is both effective and lawful.